Hello friends, a very warm welcome to my channel. In today's video, we are going to analyze another very interesting company which belongs to a very niche business. It supplies specialized batteries to the defense sector. This is another microcap company which we are analyzing, which is High Energy Batteries Limited. So before we begin this video, there are a few things I wanted to discuss with you. The first thing is, all the videos which I am making are of the companies which you guys are choosing on the Telegram channel. So I am creating polls on the Telegram channel where the highest voted company is which I am analyzing. Second thing, the purpose of the analysis is not to recommend you to buy something right now. If you have heard Mr. Vijay Kedia speak about this earlier, he watches companies and tracks them for as long as 3 to 5 years before entering them. So the purpose of watching the video is not just to buy the share, but to understand the company, to understand the business of the company, and you can keep it on your watch list and keep tracking it till you get that valuation comfort on that share and then add it in your portfolio. Thirdly, when you're watching any video, it's not just that particular company which we are speaking about. You also get to know a lot about that industry, what key triggers are there in that industry for growth, what you should look at, what are the risks in that industry. So all these things will enhance your knowledge towards that industry, which will be helpful for you to understand any future company which you read about in that industry. So as we are choosing companies based on the Telegram poll, if you are not a part of our Telegram channel, do join right now by searching my name on the Telegram, which you can see on the bottom left of the screen. Let's begin the analysis of High Energy Batteries Limited. So this company is into manufacture of specialized high-tech batteries specifically for the defense sector. They have business coming from other automotive sectors as well, but that is only a minor portion of their revenue. This company was started in 1979 and a majority of their revenue comes from manufacturing of silver zinc batteries. The company has a technical collaboration with Yardney Electric Corp for manufacturing of their silver zinc batteries, and mainly their batteries are used in the defense sector, which is the Air Force, Navy and the armed forces, and some of their batteries are also for commercial uses like the auto and industrial sector. So the company has in-house capabilities of research, development and manufacturing of batteries like the silver zinc batteries, the nickel cadmium batteries and the silver chloride magnesium batteries. Up till now, the company has supplied more than 25,000 batteries, so they have extensive experience in this manufacturing. Most of these batteries are custom designed as per their customers' requirements because they are designed for a specific purpose, and once that is approved, they keep getting continuous orders for that model. The company is also into exports to various countries, but that is a very small portion of their revenue because if they want to export any of their products, they need a prior approval of the DRDO in India. The company belongs to a well-known business group, which is the Aswin Group, which has other listed companies like the Pune Sugar, the Sheshasai Paper Industries, etc. Now coming to the management of the company, the non-executive chairman and promoter of the company is Sri Gopala Ratnam. He is a mechanical engineer from the University of Madras and by knowledge he is a technocrat. He was a chairman of the SPB group in the year 2000 and earlier he originally joined as a management trainee and still he is the chairman of the company. He has also served as a chairman of the other group companies like Pune Sugars and ESVI International. Mr. G. A. Patanjali is the managing director of the company. He has done doctorate in electrochemistry from IIT Madras. He has 4 decades of experience in the company and he has been part of many committees constituted by the government in India in this industry of energy and power sector. Now coming to the business model of the company gets its major share of revenue from the government sector, that is the defense sector. So it's kind of a B2G company. Army, Navy, Air Force and other segments of the defense sector use this company's batteries in high efficient uses. Out of the various types of battery which the companies manufacture, 97% of the revenue comes from the silver zinc batteries. When you see the breakup of the revenue, the Navy constitutes about 60% of the revenue of the company, the DRDO labs about 10%, the defense public sector about 15% and the aerospace constitute about 15% revenue. Broadly, if we see the categorization of products, we can divide mainly into the defense sector, auto batteries, VRLA batteries and the others. In the defense sectors, they manufacture batteries like aircraft batteries, the torpedo batteries, missiles and also helicopter batteries. Coming to the auto sector, the company manufactures the car batteries and truck batteries. If you see the breakup of the business in terms of the type of batteries which the company manufactures, there are mainly 3 types of batteries: the silver zinc batteries, nickel cadmium batteries and the lead acid batteries. Obviously, in the lead acid batteries, there is high competition and the company is not much interested in growing this business. Their major share of revenue comes from the silver zinc batteries, which is almost 74 crores of revenue, and just about 5 crores comes from the nickel cadmium batteries. So this is a simple business model of this company. The main product of the company are high energy batteries, and they are supplied mainly to the defense sector, and a majority of the revenue comes from the silver zinc batteries. Other than these batteries, the research and development still continues, and the company is also working on new type of batteries, which we'll discuss in the growth slide. Now let's talk about the industry. The silver zinc battery market size is about $8926 million in 2016, which will grow to about $11,400 million by 2027. The nickel cadmium battery market size can grow at the rate of 2% CAGR up to 2030. So other than looking at the market size of the batteries, we should rather be looking at the tailwinds in the defense sector in India. As you know, the government is manufacturing maximum equipments which are required for the defense sector in India. The government is trying to promote the manufacturing entities which produce defense equipments in India. There are several schemes and subsidies which the government is providing, and the size of the budget of the government allocation towards the defense sector is increasing, and the government wants to allocate almost more than 90% of their purchase towards the indigenously manufactured defense equipments. So all these things generate a lot of tailwinds for this company's business. When you look at competition, although the company is into a niche sector, it still has competition with companies like HBL Power Limited and several other generic battery manufacturing companies also like Amaraja, Exide, etc. These generic companies compete with High Energy Batteries Limited in mainly their lead acid battery segment. Now, what is the competitive strength of this company? They have in-house research and development capabilities. They have prior approvals of the defense, which is very hard for any company or a new entrant to get immediately. So they have those kind of entry barriers in their business. They have a confirmed order book of more than 80 crores presently, and they are market leaders in the silver zinc battery segment. The company does continuous R&D in the products which they manufacture, and they are even now working on new variants of their batteries. They belong to a very well-known reputed business group, which gives them an edge from a startup new company. To the defense sector, the company is a sole supplier of the silver zinc batteries, which gives them an edge over the others, and it clocks a market share of nearly 70% in this segment. Now, looking at the growth prospects of the company, the sector itself is generating a lot of tailwinds for this industry. So if you see, this company is not a new company. They have been existing. In fact, they have been listed for a very long time, more than a decade now. But now recently you see a growth in terms of the revenue as well as the share price in this company because of the tailwinds in this industry. So the government is planning a huge amount of capex towards the defense sector and specifically towards the energy and battery segment. These batteries which the company will further develop will also be used in the EV segment. So the company is already working on the lithium ion and fuel cell technologies. The company is also working on flow batteries which conserve the energy for a longer period of time. There are a lot of value added products which the company is working on, which will help the company sustain its margins going forward. The Make in India or the Atmanirbhar Bharat scheme will generate huge market size for these kind of companies. And in the past, the margins of the company have been volatile, but going forward, the management is giving a guidance in the annual report that they will try to maintain their EBITDA margin above 25% in spite of growth in the business. Now, other than the existing type of batteries, that the silver zinc and nickel cadmium batteries, the company is doing R&D and manufacturing and working on these three kind of batteries, which is the first one is the underwater propulsion battery. For this, the company has already got a 2 years contract from Navy. The vanadium based flow battery, which the company will be developing in collaboration with IIT Chennai, and the lithium battery, where the company has already developed samples at the laboratory scale, and as they become successful, the company will go for a full-fledged manufacturing. Now, along with the good things which we have spoken about, there are obviously a lot of risks which this company will face going forward. There will be fluctuations in the raw material prices which will impact the margins of the company. There can be some restrictions in the import of components which may disrupt the manufacturing process of the company. If there is COVID, there could be disruption in the manufacturing. The company derives almost 84% revenue from the government. So as you know, when somebody is working with the government sector, there are different difficulties with regard to approval of the products. If the products get disapproved even after manufacturing, there is a risk of loss. There is delayed payment. There is a lot of inventory which the company has to maintain because they can get sudden orders from the government. So all these difficulties are faced when a majority of dependencies on the government for business. If at all the government changes the policies or allocations or budgets, that can impact majorly the business of the company. The company's business is technology based, and the company, if at all, is not spending much on continuous development of newer technologies, the products may get obsolete. If you look at the financials going forward, you will notice that the company has a very long working cycle. So there is a lot of money required and parked in the working capital for the company, which is another risk going forward. This business which the company does is kind of a lumpy business. There need not be a continuous flow of business from the government. This is kind of a project based or order based business. So there could be business for a few years or a few months, and then there can be a sudden downturn. So it cannot be a uniform flow of revenue from the government. If at all the company wants to sell to others, especially for exports, the company needs to take prior approval for the government. So that will act as a speed breaker of growth for this company. And in spite of the company be operating in a niche space, there is still competition, and the government projects are generally tender based. So the person who is bidding the lowest generally gets the tender. So these are the risks the company might face going forward. Now, after understanding the business in depth, let's talk about the financials of the company. Earlier, the financials, if you see the last 10-20 years, the financials have been cyclical or range bound. The revenue has been range bound. But in the last 5 years, you see improvement in the financials. The revenue has gone up from about 60 crores to about 80 crores in the last 5 years. The EBITDA has also gone up to almost 30 crores in the last 2 years. The EBITDA margins have improved from the earlier 15-20% to almost 37 to 39%. But sustainability of these margins going forward is a question. And the company itself says that they will try to maintain them above 25%. So you can expect some drop in these margins going forward. The profit after tax has gone up to almost 18 crores in the last 2 years, and the profit after tax margins have improved to almost 22 to 23%, and there can be small pressure on these margins going forward. The reserves are steadily growing as it's a continuously profit making company, and the debt is under control. It's about 0.5% of equity, which is about 25 crores as on March 31st, 22. The trade payables are in line with the business which the company does. The fixed assets are on a decline because the company is not doing any capex in the last 5 years. The inventory is steadily growing. Now this is a critical part of this company. If you look at the inventory days are almost 500 days. So there is huge amount of money which the company is earning, which is getting locked in the inventory. The company maintains a huge amount of components for the manufacture of the products. Then after the products are manufactured, they remain as inventory till the government approves them and they take the delivery of that. So there is a long gestation period for the inventory, and that's why the inventory days are further increasing. So this could cause liquidity problems for the company if this continues the same way. The trade receivables are about 20 crores on the balance sheet, which is okay for this kind of a business, and the trade receivable days, which are the debtor days, is about 90 days, which are fairly normal for this business. The company doesn't have much cash on their balance sheet, and the operating cash flows have always been positive. So cash flow wise it is doing well. Free cash flows are almost equivalent to the operating cash flows. Now why is it so? Because the company is not doing any substantial capex in the last 5 years. So free cash flow wise the company is doing fine. Now the return ratios have improved substantially from just about 10-20% to 44 or 36% in FY22. So as the margins go down, the return ratios will also normalize going forward. The ROE is about 36%. The stat auditor of the company is Messrs. Maharaj N.R. Suresh and Co. It's a dividend paying company having a dividend yield of about 1%. The remuneration to whole-time directors is about 1.1 crore, which is normal and well within the limits as per the Companies Act, and there are no suspicious related party transactions in the company's balance sheet. Now let's talk about the shareholding pattern. Now the promoters holding is slightly on the lower side. It's just about 41%, but generally as investors we expect a minimum shareholding of about 52 to 60%, which gives us more comfort as there is more skin in the game from the promoters end. The public holds about 52% and DII 6.65%, and there are no FII holdings in the company. Now let's talk about the valuations, which is again a very critical part of the analysis what we do. The last traded price is somewhere around 300. It's a face value 2 share. The 50-week high and low is about 240 to 500. So it's still trading slightly on the lower end of the price band. The market cap is somewhere around 270 crore and market cap to sales is almost 3.5x. Historically, the last 5 years median market cap to sales is just 1.4x. PE is somewhere around 19 times earnings right now, and the last 5 years median is 16 times. Book value is 66 rupees, which comes to PB ratio of 4.5 times, and historical 5 years median is 3.5x. So it is clearly visible that the valuations have become expensive now. So if you're satisfied with the business of the company, you should be waiting for the valuations to return to their median before you buy the companies. Yes. If you look at the chart, you will find a cyclical pattern in the history because the revenue has not been consistent in the last decade. Recently, the company has been generating higher revenue and higher margins, and that is why you see a recent run up on the charts. But going forward, as the margins and the return ratios normalize, as the business of the company becomes more stable, then there could be a small decline in terms of the share price also. So for somebody who wants to invest in a company like this, has to accumulate the shares in a staggered manner at lower levels gradually, or if you want to take it at the current rate, then you should always buy with a stop loss. The third approach would be you keep this stock in your watch list and wait for it to consolidate, and when the valuations normalize, you can start entering the stock. So let's summarize the analysis. In terms of the thesis points, the sector is very good to invest in, as the next few years the government will be concentrating a lot on the defense manufacturing in India. The company has market leadership in supplying the silver zinc batteries to the government, which will give it edge amongst the other companies. There are entry barriers in this business in terms of the technology which the company has, and also the approvals which the company already has from the defense sector. Fundamentals of the company are good, except the working capital requirements, which have to be closely monitored, and the business is also a niche business which can get higher valuations going forward. In terms of antithesis points, it is kind of a B2G business because majority, almost 84% of the revenue is from the government. So there are difficulties when doing business with the government. It's a kind of a lumpy business which will not have a consistent revenue and profit growth year on year. It's a working capital intensive business, as a lot of money is parked in the inventory of the business. There is a technology risk, and the company has to continuously innovate, customize and develop latest technologies for the government of India, and there is competition in this space in spite of this company being into a niche business. So keeping all these points in mind, I am sure you will be able to take the right decision of investing in the company. So I hope you like the analysis. Thank you for watching, and if you want me to make videos on your favorite stocks, don't forget to comment those names in the comments below. Don't forget to join our Telegram channel where we post daily market analysis, and thank you for watching and have a wonderful day.